Hey guys, welcome back to Old Guy Talks Money. Today we're going to talk about options trading and whether it can be a viable strategy for generating additional income in retirement. At the end of the video, I'm going to shuck some corn and show you what I did during the month of April. I'll show you the trades I made, and I'll show you how I generated almost $7,500 just trading options. So let's get started. Guys, before we get into this very deeply, I thought this would be a good opportunity to talk big picture. What is an option? How does it work? So that we get a baseline, a level set as we move into the specifics of what I did in April. There's going to be a wide range of people on YouTube, from novices to experts, and I don't know where you guys are. And honestly, it's not my goal to make you experts. I don't think I'm an expert. But I do want to at least set the stage as we move through the conversation so that you have a frame of reference. So, what is an option? Well, an option is a contract that gives the buyer, and there's going to be two sides to this transaction, the buyer side and the seller side, gives the buyer the right, but not the obligation, okay? They do not have to do this, to buy or sell the underlying asset by a certain date. We call that the expiration date, at a specified price, and we call that the strike price. One strategy I use is covered calls, which means I'm selling a call option on a stock I already own. Has to be 100 shares, that's one contract. But I am selling the right for the buyer to buy those shares at the strike price. If I'm happy with it, it's all well and good. I collect the premium, he exercises the option, and the stock gets sold, okay? Well, why would I do this? Well, for that right, he gives me income. I earn extra income from the premium. And guess what? If we get to the expiration date, he doesn't exercise the contract, I still get to keep that premium, okay? Conceivably, you could roll this into the future in perpetuity if the market moved in your favor, where you just collect premium every single week, every single day, depending on what the length of your contract was. We kind of talked about how it works. I'm agreeing to sell my stock at a certain price, the strike price, if the buyer exercises that option. So here's an example. I have a strike price at 36. That's what I'm agreeing to sell it at. If the price in the market on the expiration date is higher than that, more than likely, the buyer is going to exercise it because they can buy my shares at the lower price and sell them at market and make a gain. If the market is lower than my strike price, guess what? I collect the premium, we move on down the road, and I do it again next week. So where's my risk here? Well, look at the definition. It says, limited to the loss of potential gain if the stock price goes above the strike price. Now, what does that mean? So what that means is, and there's an example. You'll see this when I, show you what I did in April. But what that means is, let's pretend I have a basis at 40. I have a strike price at 42, and at the close, the expiration date, it's 44. The buyer is going to exercise that contract, buy my shares at 42, turn around and sell them at 44. I lost that additional appreciation from 42 to 44. If I had held my shares and sold it at 44, that's an opportunity cost for me. When I go into these transactions, I look at it and say, hey, am I happy with this gain if it goes? And if it is, I set the contract and forget it. But there is a potential for upside that if the contract gets exercised, you may miss that additional appreciation. That's what that means. So big picture, what's our reward for doing this? Well, you get the premium from selling the call option. If it expires, guess what? You keep it, nothing happens. Plus, you're getting stock appreciation up to the strike price. So another strategy I use is secured cash puts. What does that mean? On the covered call side, I own the shares. On the secured cash side, I just have cash, and I want to buy the stock, or at least earn the premium for trying to buy the stock. So essentially, I am selling an option while having the cash to buy the stock at the strike price on the expiration date. And the important thing to know is you have to have the cash. They will notationally remove it from your account. It comes out of your available balance. It's not gone. until the contract's closed, and you either end up with the stock or not, and they put it back. Okay. Now, why would we do this? Well, we get the premium, just like on the call side, you get the premium for the right, and you potentially get the stock at a lower price. And why do you say lower price? Well, the premium that you receive lowers your basis on the stock. So depending on how it closes, it could be closer to market, might not be, but it is at a lower price because of the premium received. Okay. So what is the risk on this side? Well, the risk here is you having to buy the stock even if the market price falls below the strike price. So let's say, and honestly, this is how I would get into any stock position, as I would sell puts on it. Because if it's a stock I want to own, want to get into it, I'm going to sell puts, because even if I get in, that premium that I received is going to lower my basis. And that just makes sense. So, good example, I set a strike price at 36, market's at 35 when the contract expires. Well, guess what? They exercise it because the price is lower. I get into the stock. My basis is lowered. That's kind of how it works, okay? What's my reward for doing this? Well, I get to keep the premium if it's expired. And like we talked about earlier, I get to adjust my basis down by the premium received if I have to go into the stock. They call these two things, covered calls and secured cash puts, they call it the wheel strategy. So if you think about it, I'm going into the market. I'm going to sell puts to get in. When I get in, I'm going to sell calls. I'm going to try to roll the calls as long as I can, earning premium. I may get taken out. If I get taken out, earn the gain, and then I start the process all over again selling puts. So it creates a wheel. Now that we've kind of talked big picture, and I mean big picture, about what an option is, the strategies I'm using, let's talk big picture about what happened in April. I teased in the intro to this, I would show you I made $7,500, and here's the numbers. So going into April, I had 2,800 shares of Truist. Okay. 2,000 of those shares were in my taxable brokerage account. 800 shares were in my IRA, my Roth IRA. If you're curious, you absolutely can do option trading in an IRA. Okay. One thing you need to know is that in an IRA, you cannot use the money there as collateral. So you can't do margin trading, but you can absolutely do covered calls and secured cash puts. Okay. So 1st of April, and I will tell you guys, I like the weekly calls. I like to set it on Monday and just let it ride. I am not one of these guys that watches candlesticks. I'm not a daily market watcher other than see whether it's up and down. I'm looking at this. Okay, I have this on Monday. I'm happy with this on Friday, and then I let it go. Okay, it takes me about 30 minutes to do this, and that may be generous. So on Monday, 4/1, I set covered calls on 2,000 shares at a $39.50 strike price. My basis in those shares was $36. For that right, for the buyer to exercise that at the end was 15 cents, and net of the little commission they charged me, I made $286.68. When we got into that Friday, the stock closed at 38.09. My strike price was above it, and guess what? They closed unassigned, they expired, and on an annualized basis, I made 18.87%. The 800 shares that I had in my IRA, just how it happened with timing, and these premiums go up and down all throughout the day. I actually got a little bit more premium on the IRA money, so I had a 20.19% annualized return. For that first week, I made $409.36. So we go into the next week, still on the same shares, 4/8, set the contract to expire on 4/12, 2,000 shares. I had a strike price of $40. Honestly, I was kind of hoping this one would go. That was a $4 per share gain. They paid me a premium of 15 cents, so I net made $286.70. Annualized return of 18.64%. Closed at 36.77. Those contracts expired worthless. I got the premium, still had the shares. Going to the next week, 4/15, set up the contracts, 2,000 shares, had a strike price at 38, $2 gain above my cost basis. They paid me a 20-cent premium, so I made $386.70. Closed at $36.80. Those contracts expired. Annualized return 26.46%. Same thing happened in the Roth, where just based on timing, I had a little bit better premium, so a little bit better return. For that week, I made $549.38. We get to the last week of the month, 4/22. Set it up to close on 4/26. Same 2,800 shares. Same strike price at 38 as the previous week. Cost basis was the same. I got 20 cents on both the taxable and the Roth. Made $386.70 and $154.68 respectively. And guess what? It closed at 38.17, and those shares, that contract got exercised. Now, honestly, I was thinking it wasn't going to. If you think about it, they paid me 20 cents a share, and they only made 17. I don't know why they made that decision. It may be that it was 3 cents. They were willing to roll the dice with further appreciation, and they really wanted again. I don't know why, because they lost 3 cents a share on that transaction. But my annualized return on just the premium was 26.46. And if you factor in the annualized return with the gain of $4,000 and $1,600 respectively, I made almost 32% annualized. So that's what happened in the month of April. Total April income, $1,900 in premium income, $5,600 in gain. Now, let's go back to what I said earlier. Do I think this is a viable strategy to earn additional income in retirement? Well, y'all, I know $100,000, and you see this is the amount that I had in play, $100,800 is a good bit of money. But in retirement, I would think most of us have at least something. And let's say you had half of it. Well, take my numbers and divide it by half. I honestly think this might be a way to squeeze out a little extra income in retirement. Want to be clear here, not telling you guys to do it. Y'all need to do your research. You need to get comfortable with it and find out if it's something that fits within your strategies. Okay. Retirement's one of those things that there is no silver bullet. We've all got to find the way to balance it, reduce expense, make more income, whatever, so we don't run out of money. I mean, that's our biggest fear. Honestly, this is why I went into this, was I know what I have saved, but I'm trying to figure out a way that, I can, for lack of a better phrase, bulletproof it so that I've got all these levers that I can pull. There are risks here. One thing I would tell you is do not ever do this on a stock that you don't mind holding for the long term. So I'm selling cash puts. Let's say I'm selling them Truist. The bottom falls out from under me. I go in at say 38 and the market goes down to 25. Guess what? I'm stuck. I got to hold those shares till the market comes back. My ability to roll this and sell covered calls on that is pretty limited unless I'm willing to take the loss, and I wouldn't be. I would say only do this if you can hold the shares and ride out the market up and down. Honestly, this strategy works really good when the market kind of trades sideways or just kind of goes up and down a little bit. Where we are now makes me a little nervous. The S&P 500 has gone up a good bit. Well, let me say it this way. There's an accounting term, and we learned this in accounting school, back in college, called a crap ton. And it's called a crap ton since the beginning of the year. And it makes me a little nervous, and I think we're going to get a pullback. And I'm a little concerned as I'm rolling, selling puts to get in the market, collecting the premium, everything's good. I'm afraid I'm going to get in and the bottom's going to fall out from under me and I'm going to have to sit on the side. Well, that's fine. That's my mindset is, okay, I'm going to do this. I'm going to eke out this income. And then when I have to pull back and sit on the side, I'm just going to sit on the sideline and ride it out. If you Want to do this, do your research, and make sure you don't get caught holding the bag if you need the money. The other thing I would do is give you a little perspective, because I thought, you know, it sounds good, but what could I do with that $100,800? And I calculated the math. So if I put that in my high yield savings account, and I will tell you, I don't have the best. I'm sure I could find maybe a little bit more, but currently my high yield savings is paying 4.25%. Well, 4.25% on 100,800 is $4,284. If you divide that by 12, that means $357 a month of interest income. Think about the numbers I just shared with you. Week 1, I made $409.36. Week 2, I made $401.38. Week 3, I made $549.38. And week 4, I made $541.38. That's just premium income. That's just the $1901.50. Factor in the gain, that $5,600. I mean, it's blowing what a high yield savings account can do out of the water. So let's wrap this up. Do I think it's a viable strategy? I absolutely do. Do I think it's for everybody? I don't. Do I think if you had a small portfolio that you could do this? I absolutely do. You take the numbers that I have on the screen and scale your portfolio against it. Remember, you got to have at least 100 shares. That's a contract. But you could see what you could do. When I started this, I started it back in August of last year, I started with 100 shares of a stock that I already owned, and I was making $20 or $30 a week. I mean, I was just testing the waters, just trying to get my head around all this. And then I realized, okay, I can scale this up. I have a X level of risk tolerance. Let me see what I can do. When I go into retirement, this will absolutely be one of the tools that I have in my tool belt. So I hope y'all found this informational, educational, entertaining, all those things. If you enjoyed it, please hit the like and subscribe. It helps my channel grow. If you like this content, let me know. My plan, I don't think anybody would be interested in seeing this weekly. I mean, it's really kind of boring. I just set these things up. Maybe if somebody really wants me to show them how to do it, I'll do it. But I think at a minimum, I'm going to try to do monthly updates, show what I did. This month, it was just all covered calls. I'd like to show you a month where there was calls and puts so y'all could see kind of how those works. For May, I will tell you a little teaser. I'm already up $1,630. So far, May's going good. So again, y'all have a great rest of your day, and I'll look for you in the next video. Take care, guys.